company was called Hargrove Sutton Asset Management, a mid-sized private wealth management firm headquartered in a glass and brick office park on the outskirts of a major metropolitan area. It had 63 employees, roughly 400 client accounts, and a combined portfolio under management of approximately $240 million. It was, by every external metric, a well-run operation, clean audits, good client retention, a reputation for conservatism in the market that had served it well through the financial volatility of the preceding decade. The man responsible for the integrity of those numbers was a 41-year-old senior accountant named Victor Daines. Victor had been with the firm for 14 years, longer than either of the firm's two named partners had been in the industry. He was the institutional memory of the accounting function. He knew where everything was. He knew the auditors' names, their preferences, the specific line items they lingered on, and the ones they tended to accept at face value. He knew which client accounts were reviewed regularly and which were largely set and forget arrangements for clients who had been with the firm for so long that they rarely looked closely at their statements. In 2009, Victor Daines changed a number, a single number in a single client account. An elderly widow named Margaret Forsyth, whose quarterly statement showed an account management fee. Victor altered the fee entry in the internal ledger to reflect a slightly higher amount than what was actually charged, and routed the difference, $47, to an internal operational account that he had administrative access to. He then transferred the amount from that account to a personal account under his control. The transaction was 7 lines of accounting entry completed in approximately 4 minutes, and it generated no flags in the firm's internal compliance review. $47. This is where the story of $14 million begins. Not with a plan, not with a system, with a test. A single, small, quiet test to see whether the number going into the system would match the number coming out. It matched. Nobody noticed. Victor Daines went home that evening and did not think about it again for 3 weeks. Then he thought about it. Then he did it again. By 2011, Victor Daines had refined what had begun as an improvised test into a structured methodology. He had identified 23 client accounts that were, for various reasons, unlikely to generate detailed scrutiny. Estate accounts, where the primary account holder had died, and the account was being managed on behalf of heirs who had limited financial literacy. Trust accounts with complex fee structures that made individual line items difficult to interrogate, and long-term fixed income accounts, whose statements were reviewed annually rather than quarterly. For each of these accounts, Victor had developed a specific approach. Fee adjustments were kept below 1% of total charges, a threshold he had identified through careful observation of the audit process, as the point below which discrepancies were typically attributed to rounding and not investigated further. The internal account he used as a transit point for the extracted funds had been restructured twice, each time under a legitimate operational justification that he had drafted himself and that had been approved by the operations manager without close scrutiny. The personal account receiving the funds had been opened at a bank the firm did not use in a different metropolitan area in 2010. The amount extracted in 2011 was $432,000, not all in a single operation, but in 68 separate transactions across 11 months each individually unremarkable, collectively significant. Victor tracked every transaction in a personal spreadsheet maintained on a laptop that never connected to the firm's network. His running total at the end of 2011 was $620,000. He did not feel the way you might imagine a person stealing $600,000 would feel. He felt, by his own account given in a prison interview 4 years later, primarily tired. The maintenance of the system was exhausting. He had considered stopping 3 times in 2011. Each time, the consideration lasted approximately a day. Then he went back to work. The annual external audit in 2011 produced a clean report. The auditors were not, in their defense, looking for what Victor was doing. They were looking for the errors that accounting irregularities typically produce: mismatched entries, unsupported balances, undisclosed liabilities. Victor's system did not produce those errors. It produced perfectly balanced books. The money was gone from the right places and present in the wrong ones. But both sets of books were internally consistent. Clean books can be the product of excellent accounting. They can also be the product of excellent fraud. By the middle of 2014, Victor Daines had extracted $4.2 million from Hargrove and Sutton Asset Management. He had purchased, using nominee entities he'd established on the advice of an attorney who believed he was providing legitimate tax planning services, a vacation property in a beach community 3 hours from the city, a 40-foot sailboat, and an investment portfolio structured around low-volatility fixed income instruments that he found, with some private irony, ideally suited to long-term wealth preservation. He drove the same car he had driven in 2009. He wore the same suits. He ate lunch at the same desk. He received a performance review that described him as indispensable. He had also, by this point, crossed a threshold that he describes in the prison interview as the point of no return. This is not a moral assessment. He uses the phrase in a purely practical sense. By 2014, the architecture of the fraud had become so embedded in the firm's accounting infrastructure that unwinding it without detection was, by his calculation, no longer possible. The internal account structure had been legitimized through 4 years of routine operational approvals. The client account adjustments had been repeated often enough that reverting them would create the very discrepancies he had spent years avoiding. He was, as he put it, inside the wall. The way out was through it, not back the way he had come. This is a pattern that forensic accountants who study long-term financial fraud identify consistently. What begins as a correctable error becomes an irreversible commitment, not because the perpetrator is unusually clever, but because the systems designed to catch fraud are calibrated for anomalies. And a fraud that has been running long enough stops being anomalous. It becomes part of the baseline. The auditors audit against it. The compliance software normalizes against it. The only person who knows that the baseline itself is wrong is the person who built it that way. Victor Daines had a daughter who graduated from a university in the spring of 2014. He attended the graduation. He sat in a folding chair in the August heat and watched her walk across the stage, and he thought, he said, about his own father, who had worked in a factory for 30 years and died with a modest savings account and a paid-off house. He thought about the two things at the same time, his father and what he had done. and he understood that there was no version of the comparison that reflected well on him. He went to dinner with his family that evening. He paid for everything with a credit card linked to a personal account that contained money he had stolen from people who trusted his employer. He ordered the wine his daughter liked. In the spring of 2017, a new junior auditor named Christine Patel joined the external firm that handled Hargrove and Sutton's annual audit. She was 26 years old, 18 months into her professional career, and she had a particular interest in the kind of pattern analysis that is not standard in a routine annual audit, but that she had studied in her graduate program. During the 2017 audit, while reviewing the fee structure for a subset of trust accounts, she noticed a statistical pattern. Not an error, not a discrepancy, but a pattern. The fee adjustments for a specific category of accounts showed a distribution curve that was subtly too regular. Natural accounting variations produce irregular distributions. Exceptionally regular distributions sometimes indicate that the variations are not natural. Christine Patel wrote a note in her working papers flagging the pattern as something worth examining further. She brought it to her supervisor, a partner at the auditing firm named Donald Graves, who had audited Hargrove and Sutton for 11 years. Donald Graves reviewed the note. He looked at the distribution analysis. He told Christine that fee structures in trust accounts at wealth management firms were inherently complex, and that the regularity she was seeing was likely a function of the firm's automated fee calculation system, which would naturally produce more regular outputs than manual processes. He told her to note it as reviewed and move on. Christine Patel moved on. She filed the note. She finished the audit. The 2017 audit produced a clean report. Victor Daines did not know about Christine Patel's note until it was entered into evidence at his trial in 2020. When he was told about it in the pre-trial proceedings, his attorney described his reaction as a very long silence. The near miss had passed within 4 inches of exposing everything. It had been deflected by a senior auditor's confidence in his own experience and his own prior clean reports. The same confidence that had protected Victor's system for 9 years. After the trial, Christine Patel gave an interview to a professional accounting journal. She said she still thought about the 2017 audit and what would have happened if her supervisor had followed up. She did not say this with bitterness. She said it with the measured tone of a professional who had learned something important about the gap between seeing a problem and having institutional support to act on it. Victor Daines was caught not by a clever investigator, not by a whistleblower, not by Christine Patel or anyone like her. He was caught by a software upgrade. In January 2020, Hargrove and Sutton migrated to a new accounting platform. The migration required a full reconciliation of all historical transaction data, a process that imported 11 years of accounting records into a new system that organized and analyzed them in ways the old system did not. The reconciliation software flagged 43 transactions across the 11-year data set as requiring manual review. Victor Daines was responsible for the migration. He was responsible for reviewing the flagged transactions. He spent 6 days reviewing them and could not reconcile 4 of them in a way that would survive scrutiny. He submitted a memo to the firm's operations partner, acknowledging a data migration discrepancy and suggesting that the 4 unreconcilable transactions might reflect a system limitation in the old software that had been masking certain fee calculation errors for years. He proposed a manual review process. The operations partner, a detail-oriented woman named Helen Park, who had always trusted Victor implicitly and who was now reading his memo with a different kind of attention than she had ever applied to his work before, authorized the manual review and also, quietly, contacted the firm's outside legal counsel. The manual review was conducted by a forensic accounting firm hired by outside legal counsel over 30 days in February and March of 2020. The forensic accountant's report, delivered on March 31st, 2020, identified systematic fee extraction across 47 client accounts over 11 years, a total of $14,312,000 routed through a series of internal accounts to external destinations, and a documentation trail that they described as the most technically sophisticated internal fraud we have reviewed in 17 years of forensic practice. Victor Daines was arrested in April 2020. He did not resist. He did not attempt to flee. He did not, according to the arresting officer's account, seem particularly surprised. He was 62 years old. He had been stealing from his employer and its clients for 11 years. He was convicted in 2021 on 8 counts of wire fraud, securities fraud, and breach of fiduciary duty. He was sentenced to 12 years. He will be 71 when he is eligible for release. The sailboat was sold at auction. The beach property was seized as proceeds of crime. The investment portfolio was liquidated and applied, partially to client restitution. Client accounts were made whole by the firm's insurance. The firm survived, barely. Helen Park became managing partner. She replaced the audit process entirely. Victor Daines built his fraud on a single powerful insight: that the systems designed to detect financial crime are calibrated for anomalies, and that a crime which has been running long enough stops being anomalous. It becomes part of the baseline. The auditors audit against it. The compliance software normalizes against it. The only person who knows that the baseline itself is wrong is the person who built it that way. The near miss in 2017, Christine Patel, the junior auditor, the distribution analysis that was almost too regular, is the detail that I think about most. She saw it. She had the analytical training to recognize it as a pattern worth examining. She was overruled by a senior partner with 11 years of experience of clean audits, who trusted his experience more than her analysis. This is not a story about incompetence. It is a story about how certainty, accumulated through years of correct assessments, can become indistinguishable from complacency. The software migration caught what 11 years of human auditing missed. And this is not a comfortable conclusion, but it is an honest one. The capacity to detect fraud at the scale Victor Daines operated was not primarily a function of human vigilance. It was a function of a new system that analyzed 11 years of records simultaneously and flagged patterns that no individual human reviewer looking at a single year's audit could have identified. The lesson is not that human auditors are inadequate. It is that the systems supporting them need to be designed for the full arc of a fraud, not just the most recent year. Victor Daines is 62 years old and in federal prison. The clients whose money he stole were made whole through the firm's insurance. The junior auditor who almost caught him is now a partner at a different firm and has published a paper on anomaly detection methodology in private wealth management audits. Christine Patel's paper does not mention the Daines case. It did not need to. The lesson is in the methodology.